Let's begin by understanding why the commencement of business is such a crucial concept under Malaysian tax law. The moment a business actually starts operations, it triggers several important tax consequences. First, this date determines when a business becomes liable for tax, not the date of registration or incorporation, but the actual start of business activities. Also sets the basis period for assessing business income under Section 4(a) and Section 34 of the Income Tax Act 1967. In other words, tax authorities look at when you first begin earning income, not just when you set up your company. This distinction is vital for new entrepreneurs and established businesses alike, as it affects when tax returns must be filed and when certain deductions become available. Understanding this starting point helps ensure compliance and avoid unnecessary penalties. Now, what exactly counts as a business under Malaysian law? According to Section 2 of the ITA 1967, the definition is broad. It covers trade, commerce, manufacturing, professions, vocations, and even adventures in the nature of trade, regardless of whether they're carried on for profit. If you're systematically conducting an activity, the law presumes you have a profit motive. But when does a business truly begin? It's not enough to simply register a company or express an intention to trade. The business is considered to have commenced only when it starts actual operations aimed at earning income. Key indicators include making your first sale, hiring staff, acquiring trading stock, renting business premises, or incurring business-related expenses such as advertising or utility setup. For example, if ABC SDN BHD is incorporated in January, buys equipment in March, and makes its first sale on March 15th, the commencement date is March 15th, the day of the first revenue-generating activity. Once your business has commenced, several tax implications follow. First, your business income will be assessed from the commencement date to the end of the basis period, which is usually the financial year. You must notify the tax authority, LHDN, and file a tax return for the year in which your business started. Expenses and capital allowances incurred before commencement are generally not deductible, except for certain preliminary expenses allowed under the ITA. Losses in the first year can usually be carried forward to offset future income. There are also special cases. Pre-trading expenditures may be allowed if they are wholly and exclusively for business, and if you acquire a business from another taxpayer, the commencement date is deemed to be the acquisition date for tax continuity. It's essential to keep detailed records of your first sale, expenses, and asset acquisitions, as these dates affect your basis period, eligibility for incentives, and deductibility of expenses. To wrap up, let's summarize the key points. The definition of business under Malaysian tax law is wide, covering many types of activities. The commencement date is the date of your first revenue-generating activity, not when you register or buy equipment. Pre-commencement expenses are only allowed if they are wholly and exclusively for business purposes. Tax assessment runs from the commencement date to the end of the basis period, and you must notify LHDN and file a tax return for the first year. Practically, always keep detailed records of your first sale, business-related expenses, and asset acquisitions. These records are crucial for determining your tax obligations and maximizing your allowable deductions. Understanding and documenting your business commencement ensures compliance and helps you make the most of available tax incentives.